Listen, thanks so much for everyone for joining us this morning. This is our first online webinar. You'll have to bear with us here. I'm sure we'll get things right, and I'm sure there'll be a few teething issues as well along the way. Thanks again for joining us. We're recording this session as well, just to say that too. What we're going to do is I'm going to give a bit of a brief introduction as to who we are and who I am, what I've done, and what we do as a firm, just to set the scene as to who we are. I'm then going to take you through a bit of a presentation that we put together, just in terms of key M&A strategies during what are obviously very uncertain times that we're currently operating in. And then, so that'll bring us up to about maybe 11:40 or so. And then we'll have a live Q&A for anyone who has any questions in relation to any of the content that will have been shared by then for maybe 10, 15 minutes. So yeah, so that's really the plan for today. Sorry, now 2 seconds. There you go. Okay, so here's our agenda that we're going to cover off. Before I get into that, I'll just kind of give you a kind of a high level as to who I am and what I've done and who we are as a firm. My name is Dónal O'Sullivan. I'm a chartered accountant, chartered director. I trained at KPMG previously, and for the past decade or so, I worked for a high net worth individual, phenomenal entrepreneur, and my role was to acquire and manage businesses for him on a global basis. And over the space of about a decade, I acquired and managed about 35 businesses on a global basis that collectively generated about 400 million of revenues and about 100 million of EBITDA. They were all niche technology and services companies in a range of different industries, from healthcare technology all the way to IT managed services, to testing, inspection, certification, compliance services, and also to financial technology and services. We've been involved in a range of different businesses over the last decade or so. I was also very involved hands-on within the businesses post-acquisition. So it wasn't just getting deals done and moving on to the next thing. It was very much make it work. So I suppose I left there in kind of the end of 2019, 2020, and obviously COVID hit. And so I took some time out and I decided to create Vico Advisory now, which is our corporate finance advisory firm. And so what Vico Advisory does very much so is we advise on the buying and selling of companies. And that's really the core of what we do. And in terms of the types of businesses that we engage with, they're all businesses that generate between 5 and 25 million of revenues, give or take, and are profitable and are well-established businesses. And we work on both the buying and the sell side. So we advise on the sale of companies, but equally we also work with larger players. So there might be private equity firms or trade buyers who are on the buy side, who are keen to acquire businesses as well. So that just sets the scene as to who we are and what we do at a high level. And I'll come back to that later on. But so I suppose the agenda for today is very much, given how difficult, I suppose, an environment we're all operating within at the moment, we decided to put together a kind of an online webinar that might unlock a couple of thoughts and challenge people's thinking around M&A during this period. So the agenda today, I'm going to take you through the current economic and geopolitical backdrop. I'm going to talk to you about, I suppose, how we came to be where we are. I'm going to talk about the impact of uncertainty within public markets, the cost of debt, and its impact on M&A. I'm going to just touch on what are our strategic options. And then I'm going to take you through some key M&A strategies that we've identified, both in concert with our clients and in terms of looking at the broader M&A landscape around what other businesses are doing at the moment to progress their M&A efforts during this period. I'm going to then talk to you about how to identify M&A opportunities. Obviously, having been involved with that high net worth individual that I worked for previously, we were very acquisitive. And so there's a lot of good knowledge there around how to go about that in a smart manner. And then I'm going to talk to you about how to execute upon those identified M&A opportunities. And then finally, we'll touch on how Vico Advisory supports businesses on their M&A journey. And then, as I said, we'll have a live Q&A, which at that point then I'll make the chat available and people can, I suppose, raise their hand and ask questions then. Okay, we hope you enjoyed. Thanks. So the first area really, just in terms of unpicking this current economic and geopolitical backdrop, how do we get to be where we are? For starters, these are the things I'm going to be talking you through in the next couple of minutes. Obviously, Ireland has had an awful lot of inflationary issues over the last number of years, and no different to most countries really, especially in Europe. So I'm going to touch on that. Obviously, there's a lot of ongoing wars and conflicts on a global basis that are having a significant impact on economic on the economic environment. And so I'm going to be touching on that. Obviously, USA imposed tariffs are having quite an impact too. So we're going to have a quick look into that. China's response to USA's imposed tariffs as well, with regards to their restrictions, just provide a bit of context around that. And then we're going to talk about the impact on interest rates and oil prices as well. So we'll jump into it. So Ireland really, thankfully now has its price inflation relatively in line with where it wants to be. But to put a bit of context into that, it's at 2% now, but that was down from a high of almost 10% in October 2022. And I suppose that's a positive. However, the issue has been around wage inflation and it being, I suppose, so low for such a long period of time. And I suppose the government has been identifying the need to grow that. And it's now at a relatively healthy area, around 4 to 5% per annum. But as I said, it's growing from low base, so it's really catching up. And the reason why that's important is because given the significant price inflation we've had over the past decade or so, and the relatively lagging wage inflation, it does result in quite a significant amount of inequality within Ireland. You'll see there comments around how much the rich have in this country versus, I suppose, the poorest. And then with regards to the poverty line, I was shocked when I saw those figures, to be honest with you. And it's something that I think the government needs to take seriously and is trying to put policy measures in place to overcome that. But despite the reasons for inequality that exist, and there are many, it is proven that high price inflation coupled with low continued wage inflation for sustained periods does have an outsized impact on the poorest in society. With regards to the next area that's causing uncertainty for us here in Ireland, there are ongoing, obviously, global wars and conflicts. And what we try to do is we just wanted to make it, I suppose, really clear to everyone the cost, which currently stands at about 175 billion, or about 1 to 1.5% of EU GDP in 2022, which is an inconsequential amount of money. And I suppose, given the fact that Ireland is part of the EU and that our fiscal policy is set by EU, that does have a genuine impact on our own coffers as a country. There's obviously not just the actual cost of the war to the EU and Ireland, but there's obviously also some GDP losses that have had a real impact on real GDP and a slowdown in in EU economic activity, and especially towards business or countries that are more dependent on Russian energy. From a corporate perspective, EU firms, I suppose the share of EU firms losing money rose, which obviously makes sense, but it's only when you see the figures how stark that is. And obviously the risk of defaulting on debt has increased quite substantially as well. And obviously there are some sectors that are more, I suppose, exposed to that than others. And we've listed them out there as transport, chemicals, pharmaceuticals, food and agriculture. Not only does it have actual cost, GDP losses and corporate impact, but from an inflationary and poverty perspective, it has resulted in a 2 to 2.5% increase in inflation. And in 2022, that did push Euro inflation up past 6%, which is quite substantial. Obviously, given the fact that most EU countries set a target of in that region of kind of like 2% of inflation. So that was 3 times the amount that's acceptable. Similarly, from a Gaza perspective, the cost of damage there is in the region of 18.5 billion at present and growing. In terms of the EU, they've made 450 million available since 2023 as financial assistance. We don't think that there's a huge amount of GDP losses or corporate impact that would have an impact on certainly Irish businesses, given the limited exposure that Irish businesses would have to Israel and Gaza, or certainly Gaza anyway. From an inflationary and poverty perspective, obviously, though, there's a real indirect cost to Ireland and the EU in terms of the displacement of these people. And that's a trend that we continuously see over time growing. It's the constant need for housing refugees. And that's something that it's an ongoing cost and also it's an administrative burden for countries within the EU to have to figure out the best way to deal with this growing issue. There are other conflicts and wars out there, not just obviously Ukraine, Israel and Gaza. So in Yemen, Myanmar, DRC in particular, there are other conflicts that we'll touch on perhaps maybe a little later, but there are other impacts that are causing uncertainty from a global economic perspective too. Now, the actual cost in respect of Yemen, Myanmar, and DRC should be limited, relatively limited to EU for EU countries. However, there was quite a significant amount of GDP losses and corporate impact, certainly indirectly arising from global trade and disrupted trade routes. So you'll have seen in the newspaper only in the last number of days, the Suez Canal has come into question again, and access through that channel for global trade, and the need to go around the Cape down in South Africa as an alternative route, which just has a significant impact on prices as well as time it takes for goods to travel. So that hits all of our pockets. I suppose the other thing as well is the DRC in particular is one of the biggest exporters of cobalt, copper, gold, and diamonds and lithium in the world. And obviously all of our electronic cars that we drive here, they all have lithium batteries in it. And I know that's changing from a BYD perspective. They've come up with a sodium battery, which is great and very innovative. But at present, it's really, these wars and conflicts do have a really little indirect impact on the goods and services, certainly the goods that we consume on a daily basis in Ireland. And then finally, from an inflationary and poverty perspective, similarly to what I mentioned there with regards to Gaza, there is going to be continued need to house refugees, and the cost, inflation certainly within Africa as a continent is growing. We're certainly seeing that, and that is having an impact in terms of trade with EU. So those are, I suppose, our wars and conflicts. Moving a little bit further across the Atlantic then to the US, obviously President Trump's imposed tariffs a number of weeks ago have had quite an impact on global markets. We try to break it down very much at a high level into these 3 or 4 areas. And from a price of European goods perspective, the introduction of the 20% custom tariffs or duties on European products, they could lead to deflation actually, ironically, or lower prices in Europe. And that can be seen as a positive and a negative. The reason why that could happen is because there is, as a result of the tariffs being imposed upon European retailers and companies, there are other trade relationships building. And one that the EU is certainly building is closer with China. And as a result of that, there is an increase in supply from China of goods to the EU. That's one reason why prices can go down. But the other reason is because European exports destined for the US are actually remaining in Europe now, which is an interesting nuance. And then, so I did mention lower prices could be a good or a bad thing. So it could be good for stimulating purchasing power, certainly, and consumption within Europe. However, it could be harmful to the EU economy because it obviously encourages households to postpone their purchases because I suppose they're not sure where prices are going to go. And so it's that fear of missing out whereby people might say, hold off on buying now. And so obviously, lower prices for European goods can mean less revenue for retailers, which then could mean a reduction in the amount of wages that they could actually pay their staff. And then obviously therefore rising unemployment, which then has an impact on governmental balances and then inevitably would have an impact from a taxation perspective. From a competitiveness perspective, closer to home here in Ireland, there is some thought around the impact on these US tariffs hitting up to 25% of Irish US exports, potentially increasing the tariff rate from 5 to 6.8%. So this equates to a tariff of about 3.5 billion that hits Ireland's economy straight away. And that's separate to the pharmaceutical and semiconductors. So even taking the big ticket items out, I think there is going to be over time a marked, I suppose, impact on these tariffs that will impact our economy negatively to the tune of about 1 to 2% in the short term. From I suppose, an exposure perspective, though, Ireland does export in the region of 73 billion of goods to the US. And obviously, pharmaceuticals is a key area of that. It's a key component of that. And the jury really is out on the impact that's going to have on jobs in Ireland, as well as, I suppose, the inflation within Ireland as well. There is risk of further job losses as well in other US multinational organizations like Intel, and we'll just have to see where that goes too. So it does have this question of competitiveness that Ireland has prided itself on for such a long period of time. And the IDA have done a phenomenal job in attracting so much multinational companies, especially from the US over here, could now unfortunately have an impact of mass unemployment. So again, just adding to the uncertainty that exists within Ireland. Obviously, the response that China took to the US tariffs was to think outside the box and provide, I suppose, another fighting ground, which is these rare earth material restrictions. And to be honest with you, we needed to look into this ourselves when this was first announced. These rare earth materials, they refer to 17 chemically similar elements that are found in the Earth's crust, and you'll see them there in our diagram. They're the, what's amazing about this is that China is just so dominant in terms of these rare earth minerals. They have about 60 or 70% of the global production. And what's also scary is that they've got around 90% of the global refining capacity, which is stark. And these elements are used in everyday products like electronic products in particular. And when China imposed a restriction on the exportation of these rare earth minerals, I suppose there was a real come to Jesus moment that this could be quite significant from a US perspective in particular, but also caught in the crossfires is obviously the EU and Ireland being part of the EU. It's the industries that are going to be hit the most are really automotive, wind, power, and electronics, because I suppose they're more vulnerable to the supply and demand of these products, these components, apologies, that China can restrict. And what is the EU doing to address this? They are working with large organizations to ensure that they stockpile, that they secure direct access to raw materials outside of China, that they recycle more, and that they substitute rare earth materials with alternative technologies. But I do think that we've got a long way to go in that regard, and we're only really seeing the start of this as an economic tool. But I suppose as a result of that, there's likely to be growing inflation due to the increased cost of sourcing these rare earth minerals from countries like Australia, Canada, and the US. So closer to home then, from an Irish perspective again, and just to set the scene here, like for the previous decade, we obviously had quantitative easing across the EU, and we actually had negative interest rates for quite a long period of time. It was only in July 2022 that they became positive again. And as you'll see there on the graph, there was only one direction of travel for over a year anyway. And that was obviously in response to the growing inflation that existed in Europe. And as you can see there, they raised rates quite aggressively over that period and did a good job in reducing inflation. And however, I suppose now that there has been a gradual reduction over late 2023 into mid 2024 last year, but now what's happening is obviously with this growing uncertainty and the need for, I suppose, more of a re-injection of capital within the economy, the European economy, arising from, I suppose, these external shocks and geopolitical issues that have really stymied continued growth. The ECB has been reducing rates and will probably continue to reduce rates. And look, we see that as a positive to a large degree. It should result in cheaper borrowing and a greater availability of debt. We're hoping that that continues and that it spurs on more M&A as well. Just a quick note on oil prices, obviously a key economic indicator. And so we just focused on the last number of years there. As you can see there, it did grow quite substantially, like coming out of COVID there. And it obviously had a high of around that kind of 117 or so per barrel back in mid 2022. It's now hovering at around half that. And over the last year, it's fluctuated from a high of about $75 to 61. And to kind of give people a kind of a sense as to why this is important, the estimates from the ECB is that just an increase of 1% of oil in oil prices could lead to a decline of about 0.02% in the euro area's potential output. So like oil is obviously it's a good that it's got a finite life, and obviously electronic vehicles in particular is a positive as a substitute, but oil is used in so many different products and that can be overlooked by people. And so we have a long way to go still on reducing our reliance as a world economy on it as an asset. And given the uncertainty that exists, the outlook from players in the market is that crude oil prices will be negative or they'll be at the very least, they'll still hold steady, but perhaps maybe no higher into 2026. It's just purely down to the significant unpredictability that exists. I suppose the impact of all this uncertainty has shown in public markets as well. And so as you can see there, like obviously public markets, asset managers and pension funds advise their clients on investing into either indices or specific stocks or mutual funds. And obviously they're a key asset class for those types of investors, retail and also institutional. And so they have been performing quite strongly over the last number of years, just generally speaking. But we wanted to point out how they're not immune to specific shocks. And so you'll see here the Stocks Europe 600 index and the Nasdaq Composite Index, they both fell between 10 and 12% across the week upon the announcement of the US imposed tariffs. And I suppose it's a stark reminder of the fact that no asset class is safe. We've also seen a real shift to gold, and it's probably at its highest price for quite a while, and even cryptocurrency as well, a real resurgence around that as an asset class too. And that just points to the fact that there's where else can investors put their capital? Yeah, because people don't feel confident enough in traditional investments like stock market investments. So I suppose just wanted to touch on that because it does have an impact on the cost of debt and M&A as well. We did touch on the cost of debt from an interest rate perspective with regards to the ECB setting their rates, but I just wanted to touch on, I suppose, the impact that it has from an M&A perspective, and also to highlight perhaps maybe a newer kind of asset class that perhaps maybe some of you might not be too familiar with. But arising from the fluctuating interest rates that I touched on earlier on, and they have been because of the various economic shocks that we've experienced, the cost of debt has typically risen, and there has been a lack of availability for good opportunities. Like we're seeing that from an M&A perspective, lenders are a bit more cautious when it comes to lending for LBOs and to finance acquisitions. And there's just greater scrutiny being applied for perhaps maybe opportunities that wouldn't have been as scrutinized as quite starkly. From a private credit perspective, this has been the winning asset class over the last number of years. And despite this, I suppose, the slight reduction in 2022, 2023 due to interest rate rises, it has grown quite substantially as an asset class. And we're now seeing quite a lot of private credit, I suppose, presence within the UK and Europe, and as well in Ireland too. It is growing as an asset class. And you'll see there some statistics around the prevalence of it. And I think, look, our comment really here is around this is because traditional banks, just from a regulatory perspective and from a risk perspective, they're not able to, and from a higher capital requirement perspective, they're not able to pull the trigger as fast or as a flexible kind of vehicle for capital attainment, especially from an LBO or an acquisition perspective, that the private credit class can do. It's just one stark change from a cost of debt perspective. From an M&A perspective, then obviously, look, there was a record M&A activity kind of period in EMEA from 2021 to 2022. In 2021 and 2022, and obviously that was really because of the pent up kind of demand that existed from the fallout of COVID, and obviously it took a hit due to a mixture of economic uncertainty, valuation disagreements, and regulatory changes. Because with regards to the interest rate changes that existed, where a seller of a company said, well, there were people coming to me, buyers coming to me and saying we could pay between 8 and 10 times, and now it's between 6 and 8 times for their business, for example. That resulted in an awful lot of lack of M&A activity during that kind of 2023 period. And it's growing a little bit from that kind of low in 2023. So 2024 was a positive year, but we still do feel that there are some differences in valuations between buyers and sellers. And that, plus the lack of availability of traditional debt and the need for, as I said just now, private credit to step in on occasion to be able to bridge that gap, is hopefully going to fuel greater M&A activity in 2025. The other trend that we've noticed, as you'll see from that graph there, is that there has been a move towards acquiring smaller businesses. And it's, I think, predominantly because there is a wall of capital that still exists for private equity firms out there, predominantly because of the quantitative easing that happened over the previous decade, and the need for capital to find a home, really. But from a debt perspective, it hasn't been as easy for investment firms to raise it. And as I said, due to the scrutiny that exists, the increased scrutiny, it hasn't been as easy to obtain it for the opportunities that investment firms have wanted it. So as a result of that, investment firms are trying to be a bit more creative and try and complete transactions without the use of debt, or perhaps maybe using less debt. And I suppose, obviously, smaller transactions, smaller businesses, they typically do trade for a lower EBITDA multiple, You can get a bit more flexible on the terms. There can be a bit more rolling into a new structure, for example. All of that resulting in less capital requirements upfront for the investment firm, and that's a trend that we expect to see continue into 2026. Sorry. So I suppose, what are your strategic options as a business who is looking to grow? Look, in our view, you can do nothing and sit tight, or you can act by capitalizing on market conditions via M&A. And as Warren Buffett said, our favorite long-term thinker, don't waste a good recession. We're not obviously quite there yet, but all of the indicators would suggest that it's not beyond the realms of possibility that there could be a global recession coming. And the key piece of advice from Warren Buffett is, in this period, to build liquidity, to invest in capital, invest your capital in proven companies, to stick with your normal game plan, to avoid putting your capital into no growth assets, easier said than done, and to keep a long-term outlook. And those are the things that, I suppose, over the previous decade, when I was working for that high net worth individual, we certainly were very disciplined around each of those as a game plan or as a playbook towards our own investment theses. So I suppose we're now into the section where we're going to talk to you about some key M&A strategies that you can employ during these uncertain times. And I suppose we wanted to, in the first instance, talk to you about what are those attractive characteristics that a potential acquirer would look for in a business if you were selling your business, for example, or looking to get it ready for sale in times to come. I suppose these are the characteristics that we always employed, again, when I was working for the high net worth individual over the previous decade. But we're now seeing, I suppose, a more definitive move towards these types of characteristics for acquirers in looking to acquire businesses. I'll take them bit by bit. Acquirers are looking for well-established, well-run businesses. And the reason for that at a high level is just because of their robustness, their ability to not be massively disrupted by economic shocks or one-off unforeseen events. Because again, if you think about it, in particular for a private equity firm, they've got limited partners who invest in that fund and who are looking for a return over a period of time. And for the private equity firm, if you can make their life as simple as possible, by virtue of setting your business up to meet their needs and characteristics, then that's obviously going to help you in the success of potentially disposing of your business. So the 7 characteristics that we've identified are strong management team that are happy to go on the journey with an investment firm and who potentially have M&A experience, having completed transactions previously. Because one of the key areas that private equity firms do like to do when they look to acquire a platform business is they like to, I suppose, identify bolt-on acquisitions to that business. And an operator who comes to them ready for that challenge with specific experience and knowledge in that space already definitely stands a better chance of getting a deal done. 2, as I mentioned just now, the robust financial performance and position that can withstand external economic shocks. And I suppose, what does that mean? Financial performance is really around your P&L, and position is around your balance sheet and cash flow. Obviously, and this might sound basic, but ensuring that your business is growing and not in decline, but not just growing, ensuring that your business has the right type of revenue. Obviously, you don't want to be selling fivers for 450. It has to, the revenue that you look for and that you achieve from your client base needs to be sustainable long term, or certainly in the medium term, whereby you're generating a good quality EBITDA margin off that revenue, or certainly at the very least gross margin. And then you obviously manage your SG&A or your administrative expenditure appropriately to ensure that your revenue is generating you a good quality EBITDA margin. And from a financial position perspective, obviously you've got assets and liabilities within your business, and it depends on the nature of your business, obviously, as to what those assets and liabilities look like. But managing each of those areas appropriately is of really high importance to potential acquirers. 3, strong barriers to entry. So these could be a range of different things. It could be technology, it could be intellectual property, it could be market share, high market share, it could be exclusive distribution agreements. There are a range of different potential barriers to entry, but it talks to, I suppose, the moat that Warren Buffett would mention very famously. 4, I suppose, operating in a well-established industry that's experiencing good growth, and that your business is hopefully performing better than your industry. There's no point in investing in an industry that's only going one way. Potential acquirers are very cautious about that. And hopefully that market will be a somewhat fragmented market because, as I said previously, potential acquirers do like to consolidate markets at times. And then number 6 is very much the interest and the potential for you as the owner of the business to roll a portion of your equity into the new structure with an investment firm. That's something that private equity firms you typically not expect, but would look very favorably on. And then finally, clarity around what a potential acquirer or a large trade buyer would get from a return profile. Typically, private equity firms look to acquire businesses and over a 1 to 3 year period, hold them for a further 1 to 3 years, and then look to exit those businesses in the final 1 to 3 years, typically speaking. And they're looking for anywhere in that kind of like 3 to 4 times return, depending on the private equity firm. And so if you can think like they think and try and figure out a way of getting your business set up in a manner and doing a deal that would work for both you and them in that context, then that's how you're going to achieve success. So I suppose we always ask our clients, our prospective clients as well, does your company meet each of these characteristics? And if not, what can you do to improve that? I suppose traditionally M&A has resulted for a number of reasons. I suppose generating synergies, so both revenue and cost synergies, market consolidation that I just touched upon then, whereby you're reducing competition so that you can charge higher prices and you can reduce your overheads by virtue of not having to innovate as much because where else is the market going to go? Acquiring a new product or a new service line that complements an existing product or service line, access to new markets, or acquiring good quality team members, talented team members. So that's traditionally why M&A has occurred, right? But over the last number of years, I suppose given the fact that we're now operating in a different environment and quite an uncertain environment, there's now a number of other reasons why M&A is occurring. And these are just some of the areas that we have experienced in and covered and are seeing in the market. So M&A is now being used as a risk management tool. You'll see there an example there of a bank acquiring a credit card company, and that was something that we saw firsthand. As a supply chain management tool, again, something we saw firsthand where a manufacturer acquired a supplier to reduce the risk of the supply chain disruptions. As a refinancing tool, again, something we've seen as well, where I suppose acquiring more financial health within an organization it was palatable to the acquirer and just to improve their sustainability long term. As a geographical hedging tool, we're obviously seeing that across the board from a financial services perspective over the last number of years. As a regulatory management tool, we're definitely seeing this as a driver of acquisitions, where I suppose there are regulatory requirements coming down the track or in existence right now that businesses just can't seem to get their head around or don't want to put a significant amount of capital into, or would like to turn that regulatory headache into a revenue generating opportunity. They will look to acquire businesses that are operating very substantially from a regulatory perspective in either their industry or in an adjacent industry. As a technological advancement tool, thinking about cloud strategy in that instance with Red Hat, but also AI obviously is a huge driver of M&A at the moment. And obviously the jury is out with regards to who's going to be the big winner from an M&A, from an AI perspective. But it goes without saying that technological advancement is something that from an M&A perspective, we're seeing more and more of. This is an interesting one though, as a barrier to entry tool. We just included Google's acquisition of Fitbit there as an example, but it can be a way of shutting out other potential players into a space. As a media broadcasting tool, so the acquisition of Twitter was a classic example of that. A political tool, which is interesting how President Trump has been using the ongoing acquisition of TikTok. And then finally, as an ESG tool. So we're definitely seeing that as well for businesses that perhaps maybe might not be as good from an ESG perspective as they could be, or perhaps maybe operating in an industry that would traditionally not be very good for the environment. They're very much looking at M&A as an ESG tool towards, I suppose, making those ESG targets more attainable for them. And of course, there can be some greenwashing there, but I suppose there are also some, very conscientious businesses out there that are genuinely looking to make a real difference in the world. But yeah, so I suppose the key question we always ask our prospective clients nowadays and our existing clients is, are you innovating through M&A? And if not, you're going to fall behind, because I can guarantee you your competitors are either innovating now or they will in the not so distant future. So you need to think outside the box. With regards to identifying M&A opportunities, here's just 5 areas that I suppose with our experience we have identified. And for starters, M&A needs to fit in from a vision, mission, values perspective. That's, as a concept, you need to be open to M&A, and there needs to be buy-in across the entire management team. If not, it's not going to happen. We always recommend that you put a plan in place with regards to exactly what type of businesses, what types of transactions, how are you going to finance them, and then also to put in like an ideal M&A transaction, a list, a charter down where this is exactly what it is that we want to do, and get signed off at board level to go search for those types of deals. Patience is a virtue. It takes time. You have quick wins, but in our experience, you have to set expectations appropriately and have short, medium, long-term plans for M&A. And then finally, clarity as well as cash is king. So being able to clearly dictate what the company wants to achieve from an M&A perspective, and equally, and just as important, what it doesn't want to acquire, and sticking to that in a disciplined manner should yield good results. And I suppose that's what we do. We hold our clients' feet to the fire, and we bring that element of discipline and independence to their decision making. So I suppose, like it's crucial to enlist the services of the right advisors around you who understand your strategy and who have the experience, the values, alignment with you, and the capability to execute. So I suppose, we often ask our clients or our prospective clients, look, have they ever attempted M&A but failed for any of these reasons? And I can guarantee you it's rare that failure with an M&A stems from anything beyond these 5 areas. In terms of executing, because obviously identifying is one thing, executing is another. Communication is critical. Speed is critical. Decisiveness is critical. Being able to put your hand up and actually fight for a transaction internally is critical as well, because we've seen plenty of really good transactions just fall by the wayside because of the fact that someone wasn't willing to champion a transaction internally. And that's something that we work very closely with our clients on. Being upfront and not hiding things, and that can be around when you're discussing things with prospective acquisition targets as well as internally, because we always said that things are going to come out in the wash. So you may as well you'd be better off being upfront about issues and problems when they arise. Mitigation is critical. So being able to understand the risks, and that's an issue in its own right, but then also being able to mitigate them appropriately by deal structuring or by getting W&I, warranty and indemnity insurance, or I suppose keeping certain individuals on for longer, linking their performance to the outcomes of the business. There can be a range of different ways of mitigating risks, but it's critical to be able to understand and mitigate those risks. And then finally, look, on the whole execution, it is an art, not a science. There's plenty of reasons why M&A doesn't complete, but I suppose therein lies the reason to work with experienced advisors who have been there, done that, who've experienced a significant amount of transactions and who've seen an awful lot of good and bad, and who can advise you appropriately. So I suppose finally, a quick note on Vico Advisory. I mentioned to you that I'd come back to this at the start. The services that we provide are sell-side M&A advisory, buy-side M&A advisory. We do advise on debt financing. So if you're raising capital, we do provide some financial due diligence, and we do post-M&A deal integration. We, as I mentioned, the typical business that we engage with on the sell side would be businesses that generate between 5 and 25 million of revenues and that are profitable and growing. And on the buy side, we typically work with businesses that are a bit bigger, maybe doing 50 to 100 million of revenues, that are looking to acquire smaller businesses, and or with private equity firms that have a significant amount of committed capital that are looking to acquire businesses as well. And the industries that we serve stems from the experience that I have in my own acquisition experience working for that high net worth individual, where we set up big businesses in each of these industries: the testing, inspection, certification, and compliance services space, healthcare technology and services, financial services and technology, business services, IT managed services. So thanks to everyone for engaging with us there and listening to our presentation. I'd like to just stop sharing now, and I'm going to move over to the live Q&A. So here we go. Those tools. So I'm going to enable the chat. So if anyone has any questions that they'd like to ask, now it's time to do it. And if not, no problem, because I have 3 or 4 questions here that I've jotted down just in case there's no questions. So I might jump off with that if that's okay. So I suppose the first question I jotted down was, how long does an acquisition take and what are the steps involved? This is a question we get frequently from prospective clients. A transaction will take as long as a transaction will take, right? But typically speaking, we advise people to really provide a kind of a good 9 to 12 months from start to finish as a realistic timeline. It can finish quicker or it can take longer. Like, we have completed transactions in a number of weeks, and we've completed transactions that have taken years. And in terms of the steps involved, it depends on the types of transactions. So sometimes we get a phone call from a prospective client saying, "Oh, we just got an unsolicited offer from a trade buyer in our industry. Can you work with us to sell our business to this player?" And in which case, obviously, it's a much more streamlined process than if someone comes to us saying, "I want to get my business ready for sale. Can you help us with that?" And then I want to run a wide process whereby we're going to market the business to 30 companies, prospective acquirers. So in the first instance where you have an unsolicited offer, I suppose it's obviously we have to get a non-disclosure agreement in place. We have to, I suppose, understand the potential acquirer. We need to understand why they're interested in acquiring the business, what their rationale is, whether their values aligned with yours, because regardless of how much, I suppose, cash someone is looking to give you within reason, obviously, typically speaking, they'll want to hold back a portion of that, and that there would be an element of time between you achieving that, and so the values need to align. And then, like, what we would do is we would work very closely with you to get your house in order, to put together an online data room, and we would share information with that prospective acquirer as and when, and then we would get them to provide us with a firmed up term sheet, which could take a bit of time to negotiate. If we're happy with that, then we would go into exclusivity and into due diligence. And that can be all encompassing and can take as long as it needs to take realistically. But the more prepared you are as a business owner for that due diligence process, the less headache it's going to be and the quicker it's going to be. And once the prospective acquirer gets happier in due diligence, then we would start the legal documentation process, which again can take a bit of time, but we've been through it so many times now that it's very understandable to us. We work very closely with our clients to streamline that process and their solicitors. And it's something that we enjoy doing. Obviously, for larger transactions or wider transactions, it can take an awful lot longer. There can be an awful lot more steps involved. Obviously, there can be an information memorandum prepared. There can be financial models prepared, teaser documents. There can be management presentations to prospective acquirers. There can be a full-blown process letter with set dates upon which we would look for maybe a first round bid, even maybe a second round bid, depending on, I suppose, the interest in the process. And then the process then can be ran where we can provide exclusivity to one party or dual exclusivity to 2 parties, depending on, again, on the interest. And then we're basically replicating the final process that I just mentioned there. I see a few questions here. Raj, what would be a few important factors to look for when thinking about an acquisition from a sell side perspective? Yeah, obviously understanding your industry as best as possible and trying to understand who are the prospective acquirers, because we always say to our clients, we can obviously find you a buyer, but often the buyer will come from our clients because they understand the space, or they should understand the space really well. So just at the outset, just having a sense as to what does the market look like and who's a potential acquirer for your business. Then in terms of like other factors, like as I touched upon in the presentation earlier on, there are set characteristics that prospective acquirers do look to I suppose, look for when they're trying to acquire businesses. And I suppose it's really just making sure that your business meets as many of those characteristics as possible. And if not, do a gap analysis, get an external advisor in to really help you with that process. I think that those are the things that the important factors. Okay, question here. I would like to ask a question. Stocks are underperforming now. Is it suggestive to have M&A in stocks rather than in cash, so that when market goes up, there will be more chances to earn more? Okay, so if I can understand the question correctly, you're saying that, is it better for listed companies to acquire businesses as opposed to holding cash on the balance sheet, so that when the market goes up, well, there'll be more chances to earn? I think that's what you're saying. And I think if that's the question, I think now is a really good time to look like for listed companies to acquire businesses because of the things I mentioned earlier on in the presentation with regards to there's an awful lot of uncertainty and there's an awful as a result of that, a lot of buyers won't be looking to acquire businesses. And therein lies opportunity whereby people who are looking to sell their business and there can be a range of different reasons why you might look to sell your business, there should be less buyers. And therefore, if you're there at the table with cash, able to acquire these businesses, you should be able to get a better deal than at a different time in the cycle. And then all going well, and if that M&A, if that acquired business performs well, then that should have a fairly accretive impact to the listed company's, I suppose, valuation. Patrick here, thanks for the time and insight. What are the most common factors that reduce a company's valuation during the sales process? How can I proactively address this before I go to market? Okay, so thanks, Patrick. The most common factors that reduce a company's valuation during the sale process, what I would say is time is the real killer on deals and lack of momentum. So where we've seen some transactions fall over, it's because of a lack of organization and lack of perhaps maybe buy-in at owner level, like true buy-in that they've psychologically made the decision in their heart, I'm doing this. Because if someone's dipping their toe or someone's like half in, half out, that can be sensed by buyers. And so I think that time, buy-in, lack of organization, and then those characteristics that I mentioned in the presentation, if there's some question marks around that. So one of the areas that we see sometimes can be fine concentration exposure. So that's something that perhaps maybe can result in a lower valuation. So it's really just risk. What are the key risks within the business and how can we address them? So I hope that answers your question. But yeah, look, I think we're coming to a close here now. I just wanted to thank everyone for their time and for their interest and engagement there this morning. I've really enjoyed this presentation. And if any of you are interested in learning more about, I suppose, M&A and or how Vico Advisory could potentially help you to achieve your goals from an M&A perspective, we'd be delighted to hear from you. What I'll do is I'll put my details back on the screen here for anyone who wants to see. And I look forward to hearing from you. Here you go. Thank you very much.